Hey friends, my name is Z and you're watching Yi Makes It Easy. And welcome to a new video for IGCSE Business Studies, and today we have a new section, which is section 5 for financial information and decisions. And for the first lesson for section 5, we have 5.1 Business Finance for the needs and sources. And by the end of the lesson, you should be able to describe 5.1.1, the need for business finance, and 5.1.2, the main sources of finance. So check out the pinned comment for all the timestamps, and don't forget to hit the like button and the subscribe and ring the notification bell. And we'll move on to 5.1.1, the need for business finance, starting with what do finance departments do. So finance departments fulfill a very important role in the business, and they have the following responsibilities. Number 1, recording all financial transactions, preparing final accounts, producing accounting information for managers. Number 4, we have forecasting cash flows, and lastly, making important financial decisions like which source of finance to use for different purposes within the business. And here's the main reason why businesses need finance. Finance is money, and we all need money to purchase the goods and services we require, like the everyday goods like food, but also more importantly, the more expensive items such as house or a car. And businesses need finance too, and this is often called capital. And without finance or capital, businesses could not pay wages, buy materials, or pay for assets. And here are the 3 examples of why finance or capital is needed in the business. Number 1, we have the starting up of a business. Number 2, the expansion of an existing business. Number 3, additional working capital. Starting with starting up a business, for the main reasons why businesses need finance. When an entrepreneur plans to start their own business, they should think about all of the buildings, land, and equipment they will be using or need to buy in order to start trading. And these are usually called non-current or fixed assets. Nearly all new businesses will need to purchase some of these, and in addition, the owner of the firm will need to obtain finance to purchase other assets, such as inventories, before goods can be sold to the consumer and the first customer. And the finance needed to launch a new business is often called a startup capital. And number 2, expanding an existing business. The owners of a successful business will often take a decision to expand it in order to increase profits. Additional non-current or fixed assets could be purchased, such as larger buildings and more machineries. Other types of expansion including developing new products to reach new markets, and this form of growth could require substantial amounts of finance for research and development. Then we have additional working capital, and I'll skim through this. Working capital is often described as the lifeblood of a business, and it is a finance that is constantly needed by the firm to pay for all their day-to-day activities, like wages or raw materials or electricity bills. And the money available to them to do this is known as the firm's working capital. Many businesses have stopped trading not because they were unprofitable, but because they suffer from a shortage of working capital. So the third major business need for the finance is often to raise additional working capital. And in all 3 cases above, businesses may need finance to pay for either capital expenditure, like the money spent on non-current assets, or revenue expenditure, the money spent on day-to-day expenses. And it is important to understand the difference between those 2. And capital expenditure is the money spent on non-current or fixed assets, such as buildings, which will last for more than 1 year. These assets are needed at the start of a business and as it expands. And for the revenue expenditure, it is the money spent on day-to-day expenses, for example, the wages or the rents. Then we have 5.1.2, the main sources of finance. We have internal and external source. There are many different sources of finance available, and it is common to split them up or classify them into different groups. The most 2 common ways of doing so are number 1, internal or external sources of finance. Number 2, the short-term or long-term sources of finance. And we'll look into internal finance first. The most common examples of internal finance are as follows. Number 1, we have retained profits. and this is profit kept by the business after the owners have taken their share of the profit, and it has the following advantages. Number one, retained profits doesn't have to be repaid, unlike for example a loan, and there's no interest to pay, and the capital is raised from within the business. But disadvantages include a new business will not have any retained profits, and many small firms might be too low to finance the expansion needed. And number 3, keeping more profits in the business reduces payments to the owners, for example like dividends to shareholders who might invest in other businesses instead. And another internal finance could include sales of existing assets. Existing assets that could be sold are those items of value which are no longer required by the business, for example a redundant like buildings or surplus equipment. This makes better use of the capital tied up in the business, and it doesn't increase the debts of the business. However, number 1, it may take some time to sell these assets, and the amount raised is never certain until the asset is sold. And this source of finance is not available for new businesses as they have no surplus assets to sell. Then we have internal finance, the sale of inventories to reduce inventory levels. This reduces the opportunity cost and storage cost of high inventory levels. However, it must be done carefully to avoid disappointing customers if not enough goods are kept as inventory, as the business may run out of stock or inventories to sell to customers, and they would not be very happy. Then we have internal finance again, we have the owner's savings. A sole trader or members of a partnership can put more of their savings into their unincorporated businesses. And as we saw from previous chapters, the owners of these firms are not separate from the businesses, and therefore such finance is called internal. Advantages include the following. Number 1, it should be available to the firm quickly. And number 2, no interest is paid because it's the owner's own savings. However, number 1, the savings may be too low. Number 2, it increases the risk by the owners as they have unlimited liability. Then we have external finance. The most common forms of external finance are as follows. Number 1, we have the issues of shares. And this source of finance is only possible for limited companies. And this is the permanent source of capital which would not have to be repaid to shareholders, and no interest have to be paid. However, the dividends are paid after tax, whereas interest on loans is paid before tax is deducted. And dividends will be expected by the shareholders. And the ownership of the company could change hands if many shares are sold, which the original owners might object to. And then we have bank loans. A bank loan is a sum of money obtained from a bank which must be repaid, on which interest is payable. And these are usually quick to arrange, and they can be for varying lengths of time. And large companies are often offered lower rates of interest by banks if they borrow large sums. However, a bank loan will have to be repaid eventually, and interest must be paid. Number 2, the security or collateral is usually required. This means the bank may insist that it has the right to sell some of the property of the business if it fails to pay the interest or does not repay the loan, and the sole trader may have to put his or her house up as security on the bank loan. Then we have another source of external finance. We are selling debentures. These are long-term certificates issued by limited companies. And debentures can be used to raise a very long-term finance, for example 25 years. However, as with loans, these must be repaid and interest must be paid. Then we have factoring of debts. A debtor is a customer who owes a business money for goods bought, and debt factors are specialist agencies that buy the claims of debtors of businesses for immediate cash. For example, a debt factor may offer 90% of an existing debt, and the debtor will then pay the factor, and then 10% represents the factor's profit when the factory collects payment from the debtor. And here's some points here. Immediate cash is made available to the business, and the risk of collecting the debt becomes the factors and not the businesses. However, the business doesn't receive 100% of the value of its debts. Then we have grants and subsidies from outside agencies. Outside agencies include, for example, the government, and these grants and subsidies usually do not have to be repaid. However, they are often given with strings attached by the government or any other agencies. For example, the firm must locate in a particular area to increase job over there, or to bring up the land prices. Then we have importance of alternative source of capital. And here's alternative sources of capital. The sources of finance that have been explained so far are very widely used by existing businesses or startup businesses with detailed business plan supported by the owner's capital. And in recent years, other sources of capital have become available to the very small business startups, especially in developing economies, and to startups that carry significant risk, which can make sources of capital difficult to obtain. And here's an alternative source. Number one, we have microfinance. And in many low-income developing countries, traditional commercial banks have been very unwilling to lend poor people money, even if they wanted the finance to set up an enterprise. And banks did not lend because, number one, the size of the loans required by poor customer is very low, low amount, perhaps a few dollars, means that a bank couldn't make a profit from their loans. And number two, the poorer groups in society often have no assets to act as security for the loans, and banks are usually not prepared to take risks by lending without some form of security, which are assets that they can sell if the borrower cannot repay. And we have more for microfinance. Specialist institutions have been set up in most developing countries to meet the financial needs of poor people, especially poor entrepreneurs. And the most famous of these is this bank in Bangladesh. And these institutions, including postal savings banks, finance cooperatives, and credit unions and development banks, focus on the lending small sums of money to people, hence the term microfinance or microcredit, for micro referring to small. Then we have crowdfunding. And crowdfunding is funding a project or venture by raising money from a large number of people who each contribute a relatively small amount, typically using a crowdfunding platform. And it is a source which is not suitable for raising very small sums, and an invitation to global investors is not worthwhile if only $1,000 is required. Crowdfunding is claimed to have these benefits right here. No initial fees are payable to the crowdfunding platform, and instead, if the finance required is raised, the platform will charge a percentage of this fee to this amount. Number two, it allows the public's reaction to the new business venture to be tested, and if people are not prepared to invest, it will probably not be a very good business idea. Number three, it can be a fast way to raise substantial sums. Number four, it's often used by entrepreneurs when other traditional sources are not available. However, number one, crowdfunding platforms may reject an entrepreneur's proposal if it's not well thought out. Number two, if the total amount required is not raised, the finance that has been promoted will have to be repaid. Number three, the media interest and publicity need to be generated to increase the chance of success. And number four, publicizing the new business idea or product on the crowdfunding platform could allow competitors to steal the idea, and they may produce the product quicker and put it onto the market. Then we have short-term and long-term finance, starting with short-term finance. And this provides the working capital needed by the businesses for day-to-day operations. And shortage of cash in the short term can be overcome in three main ways. Number one, overdrafts. And these are arranged by a bank, and the bank gives the business the right to overdraw its bank account. And the business could use this finance to pay wages on all suppliers, but obviously you cannot do this indefinitely. And the overdraft will vary each month with the needs of the business, and it is said to be a flexible form of borrowing. And the interest will be paid only on the amount overdrawn, and overdrafts can be cheaper than short-term loans. However, interest rates are variable, unlike most loans which have a fixed interest rate, and the bank can ask for overdraft to be repaid at a very short notice. Then we have trade credit, And this is when a business delays paying its suppliers, which leaves the business in a better cash position. And it is almost an interest-free loan to the business for the length of time that payment is delayed for. However, the supplier may refuse to give discounts or even refuse to supply any more goods if payment is not made quickly. And another short-term finance is the factors of debt, which I've mentioned under an external finance. Then we have long-term finance, and this is finance which is available for more than a year and sometimes for very many years. Usually this means it will be used to purchase long-term fixed assets and to update or expand the business, or to finance a takeover of another business. The main sources of long-term finance are as follows. Number one, we have bank loans, and these are payable over a fixed period of time, and the advantages and disadvantages of these have already been considered under external finance, which I've mentioned. Number two, hire purchase. This allows a business to buy a non-current or fixed asset over a long period of time with monthly payments which include an interest charge. And the business doesn't have to find a large cash sum to purchase the asset. However, a cash deposit is paid at the start of the period, and interest payments can be quite high. And we have leasing. Leasing an asset allows the business to use the asset without having to purchase it, and monthly leasing payments are made, and the business could decide to purchase the asset at the end of the leasing period. And some businesses decide to sell off some non-current or fixed asset for cash and lease them back for a leasing company. And this is called a sale and lease back. And the business doesn't have to find a large cash sum to purchase the asset or start with, and the care and maintenance of the assets are carried out by the leasing company. However, the total cost of the leasing charges will be higher than the purchasing asset. Then we have issues of shares. And as we have already seen, this option is only available to limited companies. And shares are often referred to as equities, and therefore the sales of shares is sometimes called equity finance. And public limited companies have the ability to sell a large number of shares to general public. And these new issues, as they are called, can raise a very large sums of money, but can be very expensive to organize and advertise. And the rights issues of new shares is a very common way for public limited companies to raise additional capital. And this gives existing shareholders the right to buy new shares in proportion to their current holdings, and this avoids the problem of new shareholders changing the balance of ownership. Then we have long-term loans or debt finance. Loans differ from share capital in the following ways. Loan interest is paid before the tax and is an expense. Loan interest must be paid every year, but dividends do not have to be paid. For example, the business has made a loss. And number three, loans must be repaid, and as they are not a permanent capital. And number four, the loans are often secured against particular assets. Then we have another long-term finance, which is debentures, and I've mentioned this already, and it's under external finance. Then we have sources of finance, how businesses make the choice. We now know that the main sources of finance is available to the business, and what factors do managers consider before deciding where to obtain the finance from. We have the purpose and time period for number one. What is the finance going to be spent on? Is it to be used to pay for non-current assets, or is it needed to pay for a short-term cash flow crisis? And the general rule is to match the sources of finance to the use that will be made of it. And if the use is long-term, for example, the purchase of a non-current asset, this source should be long-term. But if the use is short-term, for example, the purchase of additional inventory to cover up a busy period, then the source should be short-term. Number two, the amount needed. Different sources will be used depending on the amount of money needed, and the company will not go to expense of arranging a new share issue if only 5,000 capital of money was needed for a short time period. Then we have legal forms and size. Companies, especially in public limited companies, have a greater choice of sources of finance, and issuing shares of debentures is not an option for sole traders or partnerships. And these businesses, if they plan to expand, may have to depend on the savings of their owners, like their own personal capital. And they also often have the disadvantage of having to pay higher interest rates to banks for loans than large and well-established companies. And then we have control. The owners of a business may lose control of their business if they ask other people to invest in their firms. And the owners may have to decide what is more important, expanding the business or keeping control of it. Then we have risk and gearing, does the business already have loans? And an important point about loan capital is that it will raise the gearing of the business, and this is the common measure of the risk that the managers are taking. The gearing of a business measures the proportion of the total capital raised for a very long-term loans, and if this proportion is high, let's say more than 50%, the business is said to be very highly geared. And this is the risky way of financing a business. And this is risky because the interest must be paid on the loans. And when interest rates are high and company profits are low, the firm may not be able to pay all of the interest. And the future of the business will be at risk, and therefore the banks will be reluctant to lend to highly geared businesses. Then we have recommend and justify an appropriate source of finance. And will banks lend and shareholder invest? A business can never be sure of being able to raise the finance, and banks often refuse to lend businesses, and shareholders may be reluctant to buy more shares. A business owner, especially for a new startup business, will increase the chances of obtaining a loan finance if the following is available. Number 1, a cash flow forecast which shows why finance is needed and how it will be used. Number 2, an income statement for the last time period, and the forecast one for the next period. And these should show the chances of business making a profit in the future. And number 3, the detail of existing loans and sources of finance being used. Number 4, evidence that security or collateral is available to reduce the bank's risk if it lends. And number 5, a business plan to explain clearly what the business hopes to achieve in the future and why the finance is important to these plans. And shareholders are most likely to buy additional shares when, number 1, the company's share price has been increasing, the dividends are high, or the dividends yield are high, or profits are rising so dividends might increase in the future. Number 3, other companies do not seem as such a good investment. Number 4, the company has a good reputation and has plans for future growth. And lastly, here's some definitions for 5.1 for business finance, the needs and sources. So for startup capital is the finance needed by a new business to pay for essential non-current or fixed assets and current assets before it can begin trading. The working capital is the finance needed by a business to pay its day-to-day costs. And we have capital expenditure. Capital expenditure is the money spent on non-current or fixed assets which will last for more than 1 year. Then we have revenue expenditure. Revenue expenditure is money spent on day-to-day expenses which do not involve the purchase of a long-term asset, for example wage or rent. And internal finance. Internal finance is obtained from within the business itself. And external finance is the opposite. External finance is obtained from sources outside of the business and separate from the business. Then microfinance. Microfinance is providing financial services, including small loans to poor people not served by traditional banks. And crowdfunding. Crowdfunding is funding a project or a venture by raising money from a large number of people who each contribute a relatively small amount, typically via the internet or a crowdfunding platform. And that's it for this video for IGCSE Business Studies Wednesday. We'll look into section 5, the first video, which is 5.1, Business Finance and Needs and Sources. And if you guys found it useful and helpful, please leave a like and subscribe and comment down below if you have any questions or criticisms. And also check out my Instagram in the description for more daily contents. And don't forget to hit the like button and subscribe to me and ring the notification bell so that you don't miss out on any future videos. And I hope you guys have enjoyed this video, and I'll see you guys next video. Until then, stay safe and happy learning.